The economy now, the Fed's key inflation rate ticked up last month. One reason it looks like markets may not get a free ride with lower interest rates as the Fed's inflation hawks get more ammunition for another possible rate hike this year. Let's bring in Tyler Goodspeed, former acting chair of the Council of Economic Advisors. Tyler, good to see you. So let's start big. What is going on with the economy right now?
Well, I think what's going on is that we have an economy that is growing above its potential. We have a very tight labor market, and we have inflation expectations that have become unanchored from the sort of 2% at which they were anchored before the pandemic. And you add all those things together, and I don't think that what we have now is sustainable.
Well, you do have strength in terms of, we saw some more evidence of strength with the consumer spending, but so much of that, Tyler, is in debt spending, or at least credit card spending, which is accumulated debt that is at historic levels right now among the consumers. Is that a problem?
So I think you touch upon what to me was the biggest red flag in this report, namely the fact that the personal savings rate went to 3.5%. It was 4.7% just a couple months ago. It was 9% on the eve of the pandemic. Wow. So for consumers over the past couple of years, what has really been sustaining consumer spending is the massive increase in excess savings that they accumulated during the pandemic. That is now gone. Adjusted for inflation, those excess savings are now gone. So when we see consumers dip into their savings, that is their desired savings that they are dipping into. So for consumption to remain growing at this sort of pace, I think either consumers are going to have to take on more debt at very high interest rates, or they're going to have to pare back on consumption.
And the question is,
neither is ideal.
Particularly if that consumption is vital. I mean, you know, what is it, 60-some% of Americans living paycheck to paycheck? Some people say, well, it's been that way for a while. Well, the point is, when inflation is high, very often you use debt spending in order to just buy the basics. And I think more of that is beginning to happen, right?
Food, energy, and rent are the biggest components of monthly budgets, particularly for folks at the lower end of the income distribution. And in the coming months, I think we're going to continue to see upward pressure on food inflation and continued upward pressure on energy price inflation. And
there's really no new incentives for supply side growth. I mean, you don't see anything coming of lowering taxes or having an extension of the Trump tax cuts or deregulation. I mean, quite the contrary. You have more regulation than ever, and that's a form of a tax.
That is, and with nothing on the supply side and a lot of continued demand side stimulus. We're talking about a $1.2 trillion so-called infrastructure bill that's being spent. We had a $280 billion CHIPS bill that's being spent, and we have anywhere from $500 million to $1.3 trillion in so-called green energy subsidies. You're pouring a lot of continued stimulus onto a supply-constrained economy, and that's why I just really struggle to see how we get back to 2% without some additional rate hikes.
And we got to go. So 10 seconds. But is the you-know-what going to hit the fan before the election?
So an object in motion tends to stay in motion unless acted upon by an external force. I think there's probably going to need to be another shock or two before this economy gets into an outright recession.
Tyler Goodspeed, good to see you. Thank you very much for being here. Appreciate it.
Likewise.
Coming up,